Imagine waking up tomorrow and discovering something shocking. The money running the entire global economy isn't actually real money. It's debt. Every dollar, euro, pound, and yen in circulation was created because someone borrowed it into existence. That means the global economy doesn't run on wealth, it runs on IOS. Here's the real mystery. If money is created through debt, and debt must be repaid with interest, where does the extra money come from? And if every country is drowning in debt, then a deeper question appears: who is everyone actually indebted to? To understand why the modern world runs on debt instead of real money, we have to go back centuries to a quiet financial revolution that changed the nature of money forever. The origins: when money was actually money for most of human history. Money represented something tangible: gold, silver, precious metals with real value. Kings and governments minted coins, but those coins contained actual metal. Their value came from what they were made of. Trade worked because money stored real wealth, but there was a problem. Gold and silver were heavy, difficult to transport, and limited in supply. As trade expanded across continents, merchants needed a more flexible system. That's when a simple idea appeared. Instead of carrying gold, people could deposit it with goldsmiths or banks, and receive paper receipts representing their gold. Those receipts could be exchanged like money. At first, this system was honest. Every note was backed by real gold sitting safely in a vault. But bankers soon discovered something important and dangerous. Most people never came back to withdraw their gold at the same time, which meant something tempting became possible. The birth of money from nothing. Bankers realized they could lend out more receipts than the gold they actually had. As long as everyone didn't demand their gold simultaneously, no one would notice. This practice became known as fractional reserve banking. It worked like this: a bank receives $1,000 in gold deposits. Instead of keeping it untouched, the bank lends out $900 while still allowing the depositor to believe their $1,000 is available. Suddenly, the economy now has $1,000 claimed by the depositor plus $900 loaned to someone else. $1,900 created from $1,000. Money was no longer just stored wealth. It was being manufactured through loans, and every loan came with interest, which meant the system now had a strange property. More money had to be repaid than was originally created. This wasn't an accident. It became the foundation of modern finance. The turning point: governments joined the system at first. Banks created money mainly for merchants and businesses. But in the 17th and 18th centuries, governments realized something powerful. Wars were expensive, and raising taxes fast enough was politically dangerous. Borrowing money from banks became the solution. One of the earliest examples came with the creation of the Bank of England in 1694. The arrangement was simple. Private investors would lend money to the government. In exchange, the bank received the authority to issue banknotes. Those notes circulated as money, even though they were essentially debt backed by government promises. This model spread rapidly. Eventually, central banks began appearing across the world. Among the most influential was the Federal Reserve System, created in 1913. From that point forward, the process became institutionalized. Governments borrowed money, central banks issued currency, and economies expanded through credit. But the system still had one remaining anchor: gold. That anchor would eventually disappear. The breaking point: when money stopped being real for centuries, paper money remained linked to gold through the gold standard. In theory, governments promised that paper currency could always be exchanged for a fixed amount of gold, but this promise created a constraint. Governments could only create as much money as their gold reserves allowed. And during the 20th century, that restriction became inconvenient. Wars, economic crises, and political spending demanded far more money than gold supplies allowed. The final turning point arrived in 1971. That year, the United States ended the convertibility of dollars into gold, effectively ending the global gold standard under President Richard Nixon. From that moment forward, Money became fiat currency. Its value no longer came from gold, it came from government decree and economic confidence. But something else changed as well. Now money could be created almost entirely through debt expansion, and it was. The fallout, the age of global debt. Once money became detached from gold, debt exploded. Governments discovered they could fund spending through borrowing rather than taxation. Banks discovered they could expand credit almost indefinitely. Consumers discovered they could buy houses, cars, and lifestyles through loans. The result was a financial system built on ever-growing debt. Today, the numbers are staggering. Global debt has surpassed $300 trillion. That includes government debt, corporate borrowing, and household loans. Entire economies now depend on continuous credit expansion to keep functioning. If borrowing slows down, economies stall. If debt stops growing, financial crises appear. In other words, the system must keep creating debt to survive. Failed fixes, attempts to escape the cycle. Over the past century, economists and policymakers have tried various ways to stabilize the system. Interest rate adjustments, financial regulations, debt restructuring, central bank interventions. But these solutions often treat symptoms rather than the core issue. Because the modern financial system has a built-in dependency, money creation requires borrowing, and borrowing requires more borrowing later to keep growth going. Central banks now play a crucial role in managing this cycle. During crises, like the 2008 financial crisis, they inject massive amounts of new money into the system through programs like quantitative easing. This prevents immediate collapse, but it also expands the total amount of debt even further. Modern parallels. The pattern repeats. If you examine modern economic history, a pattern emerges. Debt expands rapidly, asset prices rise. Economic growth accelerates, then something breaks, markets crash. Governments intervene. Debt grows even larger than before. This cycle repeated during the Great Depression, the 2008 financial crisis, and even during global economic shocks like COVID-19 pandemic stimulus programs. Each time, the response is the same. Create more money, increase more debt, push the problem forward. Which leads to the unsettling realization the global economy is less like a stable machine, and more like a bicycle that must keep moving or fall over. 3 takeaways. First, modern money is mostly debt. When banks issue loans, they create new money. This means most of the money circulating today originated as someone's obligation to repay. Second, debt expansion drives economic growth. Governments, businesses, and consumers rely on borrowing to fuel spending and investment. Without new debt, economic activity slows dramatically. Third, the system depends on confidence. Since fiat money is not backed by physical assets like gold, its value depends on trust. Trust that governments will manage debt responsibly and maintain stability. If that confidence ever weakens, financial systems can become fragile very quickly. Final thoughts. So the next time you look at a banknote or check your bank balance, remember something surprising. That money probably began its life as a loan. And somewhere in the system, someone still owes interest on it, which raises one final question. If the global economy depends on ever-growing debt to function, what happens if one day the debt can't grow anymore? If you found this breakdown valuable and want to explore more hidden stories behind global finance, central banking, and the history of money, subscribe to the channel. Because the biggest financial systems shaping the world today are often the ones most people never see.